Good morning, everyone. It's Wednesday, September 10th. Ben Buckner and Dan Bosse joining from Ag Resource Company in Chicago. We got markets more or less flat. It's kind of been a theme all week, and even chart-wise, things seem to be stuck for now. USDA's yields, first pass at objective yield data, just 2 days away now, and so I don't expect we'll do much new in the markets until we get those numbers. But in the background, still the same thing to us. It is geopolitics, currencies to some extent, and of course, maybe the last of weather and the beginning of weather in the Southern Hemisphere. Geopolitical risks seem to be elevated. Souring relations. We're separating the world into two. That was ongoing, but it seems to be accelerating now, and so I think that is dominating. And really, for now, adds to the wheat market's woes. Just one more thing for that market to worry about. Dan, you want to break down what you were seeing and what jumps out to you this morning?
Ben, thank you. And everyone, it's always good to be back after visiting with clients in Turkey and then, of course, clients throughout the UK. It's always good to come home. There's no better place than America. I think we all know that. And I'm also cognizant of, our bearish stance. We've been bearish for a while. We've got farmers well sold. We're thinking ahead of managing risk for next year, and we're thinking about how to trade these markets. And it seems like we're perma bears. If we go back to 2020 to about 2023, we were seen as perma bulls. And so, we only rely on the numbers. We are not brokers. We do not trade. These kind of things are what we try to do in managing risk with you. So as we look at the markets, we don't want to be bearish, but we are, just because of things the way they sit on the page. And so we know the markets don't have a soul. That's unfortunate. But as we look at this, we're trying to help you, the farmer, or help you, the trader, the best we can. Traders, as you look at the news overnight and where we are in the markets here today, we've got President Trump calling for 100% tariffs against China and India because they're buying Russian oil, and they're asking for the EU to join in. I don't know if the EU will join in. I'm very suspect that the EU will join in these tariff calls. Nonetheless, the United States could put additional tariffs on both China and India if they don't abate in terms of their buying Russian oil. Russian oil is cheap. There's been this alliance forming, BRICS, if you will, between China, India, and Russia. Well, let's throw Brazil in the same mixture, and you can see that they all seem to be working more closely together. But we'll watch this very carefully. But again, today the tariffs on U.S. soybeans are about 23%. And so if you think about where tariffs are today, we're really not involved in selling China any soybeans. Now, this is irrespective of geopolitical measures and whether or not we can debate China's telling its crushers or importers not to buy U.S. soybeans, which is still what we're hearing. If you look at the spread today between Brazilian and U.S. soybeans on a FOB basis, Brazilian soybeans are at about $1.05 premium here today. 23% tariff on U.S. soybeans amounts to about $2.50 a bushel. If we add in there the additional premiums for Brazilian soybeans, because there is going to be some additionality in soybean oil, and then you look at, of course, the freight advantages, we would say that Brazilian soybeans need to trade at a $2.75 premium for the Chinese to come back and buy U.S. beans, just on an economic standpoint, irrespective of geopolitics. So when you think about this, $1.05 is not enough. And we would imagine that China, who is buying November soybeans late yesterday and likely will do again today, will continue to fill up their needs through November. And I believe this is the longer term trend. As Brazil produces larger and larger soybean crops, their window of sales will push into the U.S. harvest. This is not something that's going to go away today or next year or the year after. It's only when Brazilian has small crops does the United States have that window of opportunity to sell to Southeast Asia in that September, October, November period. This is significant change we all need to be aware of from a longer term perspective. Also in the news overnight, we have, of course, where refinery state senators are looking to block Trump from shifting or reallocating SREs. We've been talking for a couple of weeks since the SRE announcement was made nearly 2 weeks ago that the Trump administration was proposing to shift those to big oil. Now we're seeing, of course, big oil pushing back, and it's really pitting big oil against big ag. If we don't reallocate those SREs, all of a sudden the RVOs have far less bite going forward, to the tune of about 1.4 billion gallons less. And so this is something that's important to the market. It's the reason why soybean oil prices have pulled all the way back to 50 cents. And if this bill gets approved or goes through, I think it's going to provide hesitation to the EPA. It is going to maybe drop the soy oil market back to 46 or 47 cents. So again, concern going forward from a demand perspective. We're still going to have bigger RVOs for 2026, but as we think about how big, they're not going to be as big as expected because of the now policy that's looking forward to block EPA from, of course, reallocation of that 1.4 billion gallons of RINs back to big oil. As you think about the Russian wheat market here this morning, we mentioned to you on Monday that the major 8 exporters of wheat are going to have record supplies, record total supplies, both in terms of production and carry-in this year. It is still pressuring the Russian wheat market. We're at 225 bid this morning, 226 offered. The next downside target is about 215, testing that old 2024 low that was found in late August, October of a year ago. So if you think about where Russian prices are going, we believe they're heading to the downside yet for another $9 or $10 a ton. We think that the market bottoms again late September, October in that 215 range. That means that U.S. wheat or December wheat probably won't get too far above 540 and has a downside potential, maybe as low as 490 or 485 a bushel. The other aspect we should be asking ourselves is, are the index funds or these long-only buyers likely to come back and own commodities or agricultures for a macroeconomic event? Now, that macroeconomic event could be inflation. We do see a little uptick here in some of their buying in the last couple of weeks. But as we stand back from it, we did have, of course, inflation data this morning, which showed negativity. So unless you really believe that the energy markets are going to have a big run, and I do not, because I believe crude oil prices are going to be sinking to the mid-50s by year end, there's really no reason for these index funds to come in and own commodities or ag commodities in a big way. They are still long of livestock, which makes considerable sense. But owning the grain markets, at least heading into the harvest here, doesn't make sense. And we'll see how this all plays out. But you need them if you're going to have a sustained rally. Our mindset longer term, as you think about the grain markets, is we still have weakness, which probably carries us into the harvest. Somewhere between October, late November, we probably form a bottom, and then we start to go sideways. You can see that as you look at world soybean prices or U.S. soybean prices relative to the CBOT, or maybe the wheat market, or maybe the corn market. After we have this kind of rally and break, we sometimes go sideways for a couple of years. And that's would be our mindset unless there's a significant weather issue in either Argentina, Brazil, or the United States, North America next year. So then after we get this break figured out in terms of how low and what is buying demand, I'm afraid we're going sideways. I don't see a rally like last year in corn that'll take us back to $5. I don't see a wheat rally ahead because of the abundance of world supplies. In soybeans, I don't see a rally because China will buy Brazilian beans through the end of November, December, which really limits or curtails our window of opportunity to sell them beans to maybe 6 or 8 weeks. So as I'm leaving this discussion, I think we all need to be prepared for some sideways trade. Again, there's opportunities here, but within a broad range. Back to you, Ben.
Yeah, that all makes sense. And I think too, just thinking about the markets, big picture wise, do we need to ration the supplies that exist today? And the answer is no. And part of the weighty nature of the market too has been weather has been good, really good in both hemispheres for a while. There's nothing we can do about that. I guess what we're looking for the next 30 days is the forecast has been pretty consistent in allowing maybe the Brazilian monsoon to kick in the next 10 or 12 days, and so that's pretty timely, pretty normal. So do we go another 6 months with pretty normal world weather? So you want to think about these things as we think about forward, risk management, of course. I think dollar gets you in for 30 days. We'll probably have new advice. We've got bi-state corn yields coming out today. And so again, think big picture, look at the forward market, 2026 contracts and the premium that exists in those. And we will get opportunities. We just need to know whether we take them or not. And until we see a big change in politics, one, and probably weather, second, you probably do want to take those. So as always, all the best in the market today. We'll be back tomorrow. One more day, full trading before the USDA's numbers, and that's going to be the excitement moving forward. So thanks for watching.